So Bitcoin is currently bleeding out toward that $60,000 support line.
Yeah, it's rough out there.
It really is. I mean, an agonizing $1.8 billion was just wiped out in forced liquidations in a single day.
It's staggering.
And looking at the charts, the market is just in pure, unadulterated panic mode. Usually when you're caught in a financial storm of this magnitude, your entire world just kind of shrinks down to the size of the waves crashing over the bow.
Right, you just brace for the next impact. I mean, in survival mode, the absolute last thing on your mind is the slow, silent movement of tectonic plates shifting, 1,000 feet down on the ocean floor.
Exactly. But if you could somehow drop a submarine beneath that hurricane, the water is completely still. The Earth is just quietly, inevitably rewiring itself, completely ignoring the chaos happening on the surface.
That's a great way to put it.
And looking at the massive stack of intelligence we have today, that feels like the most accurate way to describe the cryptocurrency market right now. So, welcome to the deep dive. We are unpacking real-time market data from XTB and CryptoQuant. We've got institutional analyses from Galaxy and Investing.com, some really dense scholarly research from SitePress.
And that sprawling Coinbase report.
Yes, the incredibly detailed 2026 Crypto Market Outlook report from Coinbase.
Our mission today for this deep dive is to look past the visceral fear of this June crash. We're mapping out the massive technological shifts happening in that deep water.
Stuff you wouldn't even think about.
Right. Everything from artificial intelligence agents, autonomously managing corporate money, all the way to a looming existential mathematical threat from quantum computing.
So let's jump straight into the wreckage of this current drop because, the waves are terrifying for anyone watching.
Yeah.
Bitcoin hit a multi-week low of roughly $65,710, and then the floor just gave out.
Completely vanished.
It slid almost straight down near 60,463. The sheer scale of the damage is just hard to process. When we talk about 1.8 billion in forced liquidations, we're talking about actual traders having their accounts zeroed out by algorithms.
Yeah, and to put the mechanics of that wipeout into perspective, 1.35 billion of that total came exclusively from long positions.
Wow. Mostly longs.
Mostly longs. These were people trading on margin. They were essentially borrowing money from the exchanges to bet that the price of Bitcoin would go up.
Right.
But when the price unexpectedly drops instead, your collateral loses value. And if it drops too far, the exchange's automated system just steps in, forcibly sells your Bitcoin at market value to cover the loan, and you lose everything.
Which creates this cascading waterfall effect. Your forced sell order pushes the price down just a little bit further, which then triggers the margin call for the trader slightly below you.
Exactly. It's a domino effect of pain.
Total pain. And the XTB data shows the aftermath. Their relative strength index, the RSI, plummeted to 17.4.
Yeah, and for anyone tracking traditional momentum indicators, an RSI calculates the speed and magnitude of recent price changes on a scale of 0 to 100.
So lower is worse.
Right. Anything below 30 typically signals an asset is quote-unquote oversold. But cratering to 17.4, that doesn't just mean oversold. It means the market has reached a state of pure capitulation.
Sellers exhausted every single ounce of inventory they had.
Exactly.
But here's where the story gets profoundly strange. You look for the catalyst of a crash like this, and you're expecting, a massive regulatory ban or a catastrophic network hack.
A black swan event.
Yeah. Instead, the psychological trigger was a single tiny corporate disclosure. The company Strategy, formerly known as MicroStrategy, sold 32 Bitcoin.
32.
They offloaded a mere $2.5 million worth of their holdings.
And the entire market seemingly lost its collective mind over an incredibly insignificant fraction of a treasury.
It is genuinely absurd to say out loud. 32 Bitcoin is less than 0.004% of Strategy's $60 billion war chest.
Barely a rounding error.
Right. So if you're listening to this and wondering why that matters, it's like seeing the captain of a massive, unsinkable cruise ship quietly put on a life jacket.
Oh, that's perfect.
Right. He isn't taking up much room in the lifeboat at all, but the signal that single action sends to the passengers on deck is absolutely terrifying. Strategy was the poster child for the never sell philosophy. They broke their own golden rule.
And the reaction proves the market isn't responding to supply and demand mechanics here. The actual order books, the digital ledgers tracking all those buy and sell orders on major exchanges, They have more than enough market depth to absorb a $2.5 million sale in a fraction of a second.
Without the price moving a single dollar.
Exactly. Traders are reacting entirely to a narrative shift. Strategy spent years pioneering unlimited leveraged expansion, borrowing cash specifically to buy more Bitcoin.
The endless accumulation loop.
Yes. So selling even a handful of coins signals a pivot toward sustainable leverage management, possibly to fund corporate dividends. It shatters the illusion that institutional buyers will just accumulate forever without ever taking profits.
But a tiny corporate sale, no matter how much it spooks the herd, does not evaporate $50,000 of value per coin on its own.
No, it doesn't.
To understand the underlying fragility of the market, you really have to investigate where the buyers went. And the crypto quant data paints a very clear picture. They all quietly slipped out the back door and headed to a completely different party.
Yeah, the real culprit behind the June collapse isn't a sudden flood of new tokens hitting the market. It is a severe, sudden vacuum of demand.
The buyers vanished.
Right. CryptoQuant tracks a fascinating metric called realized cap. Instead of just multiplying the total number of coins by the current price, which is traditional market cap, realized cap values every single Bitcoin based on the price it was trading at the last time it actually moved between wallets.
Okay, so it filters out all the lost coins and inactive whales.
Exactly. It's a much more accurate gauge of real capital locked in the network. And over this period, that realized cap dropped by nearly $40 billion.
Meaning $40 billion of actual verifiable wealth just vanished from the ecosystem.
Yep.
It fell from 1.12 trillion down to 1.08 trillion.
It's massive.
And we saw the exact same hemorrhaging in traditional finance vehicles too. U.S. spot Bitcoin ETFs endured this brutal 12-day outflow streak, bleeding somewhere between $2.8 billion and $4 billion.
While the Coinbase premium stayed stubbornly negative.
Yeah, and that premium tracks the price difference between the U.S.-regulated Coinbase exchange and offshore platforms. It proved American institutions weren't buying the dip, they were dumping.
The capital flight was incredibly directional. The sources point to a massive, coordinated rotation out of crypto and directly into artificial intelligence infrastructure and semiconductors.
Institutional money rushed to play the classic selling shovels during a gold rush narrative. But hang on, because this completely contradicts the scholarly research we reviewed. I mean, the Cypress academic paper explicitly models Bitcoin as having a historically negative correlation with tech stocks in the NASDAQ.
Yes, the diversification argument.
Right. The whole premise is that Bitcoin acts as the ultimate portfolio diversifier. If AI and tech stocks are absolutely booming right now, shouldn't these same institutional managers be piling into crypto as a structural hedge?
Well, in a textbook economic vacuum, sure, that static diversification model works perfectly, but the reality of a high-stress macroeconomic environment just shatters those models.
Real life gets in the way.
Exactly. Look at the landscape fund managers are staring down right now. We have hotter than expected inflation metrics. U.S. Treasury yields are sitting incredibly high, which makes holding risk-free government debt very attractive.
Guaranteed returns.
Right. Plus, there are major unpredictable geopolitical tensions escalating, particularly involving Iran.
When the world feels unstable, fund managers don't play theoretical 3D chess. They just want safety and cash.
Precisely. They abandoned the long-term theoretical hedge of Bitcoin and sprinted toward the immediate, massive, verifiable quarterly earnings of AI companies. They traded a macroeconomic thesis for cold, hard cash flow.
So if you're sitting at home watching ETF outflows and red candles on a chart, it feels like crypto is simply losing the great tech race to AI.
Like it's old news.
Yeah, like it was the hot innovation of the 2010s that just got permanently replaced. But diving into the Coinbase 2026 crypto market outlook flips that assumption completely upside down.
It really does.
Crypto isn't competing with artificial intelligence. Crypto is quietly building the underlying financial plumbing that artificial intelligence requires to actually function.
This is exactly where we drop our submarine beneath the surface volatility. While speculative traders are panicking over daily token prices, the underlying utility of these networks is maturing at a staggering pace.
Give me an example.
Look at stablecoins, cryptocurrencies pegged to the value of the US dollar. They have emerged as the undeniable killer application of the industry. The Coinbase models project the stablecoin market cap will hit an astonishing $1.2 trillion by 2028.
$1 trillion of programmable instantaneous fiat.
Right.
And the research reveals this incredible aha moment regarding how this money will actually be used. It centers on a concept called agentic payments. The Coinbase report highlights a protocol they developed called Buy 402.
This is
It
fascinating.
really is. Mechanically, this protocol allows autonomous AI agents to continuously settle high-volume microtransactions instantly over the internet without a human ever swiping a credit card or entering a password.
And the historical context makes this even more profound. When the foundational architecture of the internet was built decades ago, the developers reserved the HTTP error code 402 for payment required.
Right next to the famous 404 not found error.
Exactly. But 402 was never natively activated because the internet lacked the infrastructure for frictionless, instantaneous micropayments. Credit card networks are way too slow, and they charge base fees that make sending a fraction of a cent completely impossible.
Now, Protocol by 402 solves that exact bottleneck. An AI agent tasked with researching a stock could hit a paywalled financial article, instantly negotiate a payment of 1/10 of a cent using a stablecoin, unlock the data, and execute a trade in milliseconds, all completely autonomously.
It's revolutionary.
It's like judging the ultimate value of the internet in the year 2001 strictly by looking at Amazon's tumbling stock price after the dot-com crash.
So,
You would be completely ignoring the reality that telecommunication companies were quietly laying down millions of miles of global broadband cables.
that is the perfect analogy. And the structural maturation extends far beyond AI. Real-world assets, or RWAs, are migrating onto blockchains at an unprecedented scale.
Right, like BlackRock's BUIDL fund.
Exactly. The BUIDL fund, which tokenizes traditional U.S. Treasury bills,
Yeah.
just crossed the $2 billion threshold. We are seeing private credit and public equities adopting blockchain architecture to eliminate those massive multi-day settlement frictions that plague traditional finance.
It really feels like the industry is firmly entering a tokenomics 2.0 phase.
Tokenomics 2.0, yes.
Projects are finally abandoning the speculative, printing money out of thin air phase. They are instituting actual stock-like buybacks, managing transparent protocol profit and loss statements, and distributing real yield generated from network fees.
But, and this is a big but, upgrading the global financial system's underlying broadband is a grueling engineering challenge.
Oh, absolutely.
The deep dive sources highlight that the two dominant networks attempting to handle this institutional volume, Ethereum and Solana, are currently wrestling with severe multi-million-dollar growing pains.
The network wars and the liquidity trap. Let's start with Ethereum. They recently pushed through a major technical update called the Pectra upgrade.
Specifically, EIP 7691.
Right. And the goal was to help scale the network by increasing the maximum effective balance a single validator could hold. Mechanically, it was supposed to streamline operations so fewer validators could manage more staked Ethereum, which reduces the computational bloat on the network.
But instead, it exposed a massive institutional bottleneck.
Tell me about it.
Well, it centers around the mechanics of staking. To secure the Ethereum network, investors lock up their tokens and earn a yield in return. But the architecture intentionally restricts how fast that capital can be withdrawn to prevent a sudden mass exodus from compromising the blockchain's security.
Makes sense on paper.
Sure, but during recent market stress, the validator exit queue, the literal waiting line to unstake and retrieve your funds, spiked to an agonizing 45 days.
Wow. The sources documented roughly 2.6 million Ethereum trapped in this queue following precautionary exits triggered by a security incident with the firms Kill and Swissborg.
That's billions of dollars.
Stuck. Think about the gravity of that for a second. If you are an institution managing a highly liquid spot Ethereum ETF, your mandate is to allow customers to buy and sell shares every single day. How do you possibly stomach a 45-day delay to retrieve your underlying assets during a market panic?
You don't. You've identified a massive systemic friction point. For a heavily regulated ETF manager, staking acts like a financial roach motel during a crisis.
A Roche motel.
Yeah, it is incredibly frictionless to deposit your funds and start earning yield, but nearly impossible to escape quickly when you desperately need liquidity to fulfill customer redemptions. If a sudden macroeconomic shock sends every institution scrambling for the exit simultaneously, billions of dollars simply get stuck in a mathematical traffic jam.
That is terrifying for an institutional manager. And while Ethereum wrestles with its exit queues, Solana has spent years aggressively pitching itself as the lightning-fast, ultra-cheap alternative.
And Solana is absolutely capturing a massive wave of institutional volume right now, but they're undergoing a very different, very painful evolution themselves.
The meme coin shift.
Right. The chaotic meme coin frenzy that previously subsidized their network activity has largely burned itself out. The ecosystem is rapidly transitioning its volume toward proprietary automated market makers, or prop AMMs.
The sources note these prop AMMs are now handling about 80% of all aggregator swaps on Solana. We need to explain exactly how that shifts the balance of power, because an automated market maker is essentially the robotic heart of decentralized trading.
Well, in a traditional public AMM, anyone in the world can deposit their tokens into a communal liquidity pool. The algorithm dictating the price is open source, permissionless, and entirely transparent.
Very decentralized.
Very. A proprietary AMM flips that model completely. It is operated by a single, heavily capitalized trading firm. They provide all the liquidity themselves and use closed-source, secretive algorithms to execute trades.
But why would traders flock to a centralized, opaque system on a decentralized network?
Because massive institutional capital guarantees extremely low slippage.
Slippage.
Right. Slippage is the frustrating difference between the price you expect when you hit buy and the actual price you get milliseconds later as the market moves. Because prop AMMs have such deep pockets, they absorb that volatility. They offer highly efficient, predictable pricing.
The trade-off is sacrificing the foundational crypto ethos of transparency.
Exactly. Solana is effectively bifurcating into a two-tier ecosystem. You have a highly efficient, opaque dark pool for institutional whales and volatile public liquidity pools for retail speculators.
So what's the actionable takeaway for you as a listener? The expert advice points heavily toward risk management right now.
Absolutely. You have to dollar cost average into these fundamental infrastructure plays rather than chasing volatile meme coins. And watch ETF flows closely. Watch what the Fed is doing.
And the irony is, while everyone is wringing their hands today over Ethereum's 45-day exit queue or Solana's opaque trading algorithms, there's a mathematical time bomb ticking on the horizon that could permanently, forcibly unlock every single wallet on the planet.
Yes, we are talking about Q-Day.
Q-Day. It sounds like a sci-fi movie.
It really does. Q-Day represents the theoretical moment when a cryptographically relevant quantum computer finally comes online. Specifically, a machine powerful enough to run Shor's algorithm.
To understand the threat, you have to look at the math protecting Bitcoin right now, which is called the Elliptic Curve Digital Signature Algorithm, or ECDSA.
Exactly. Which operates like a mathematical one-way street. Traditional computers can easily multiply two massive prime numbers together to generate your public wallet address.
But if a hacker tries to reverse that process, trying to factor that massive public number back into its original primes to steal your private key, it would take a traditional supercomputer millions of years of brute force guessing.
Right, but Shor's algorithm rewrites the rules of physics. A quantum computer doesn't guess answers one by one. By leveraging quantum states called qubits, it can analyze vast sets of possibilities simultaneously.
It's doing it all at once.
All at once. It uses quantum interference to instantly cancel out the wrong answers and amplify the correct ones. It turns that impenetrable one-way street into a two-way highway.
The Coinbase report puts a terrifyingly precise number on this vulnerability. Roughly 6.51 million Bitcoin, which is nearly 32.7% of the entire circulating supply, are currently susceptible to these long-range quantum attacks.
A third of the supply.
Almost a third. And this predominantly impacts Satoshi-era legacy coins utilizing older pay-to-public key scripts where the public key is already fully exposed on the blockchain ledger.
Yep.
Let me offer a tangible analogy for this. Imagine keeping your entire life savings in a bank vault forged from impenetrable steel. You sleep soundly, knowing no traditional drill can scratch it.
But
you also know for an absolute fact that a rogue engineering team is spending the next decade building a hyper-advanced laser that slices through steel like butter. You have to move your wealth into a newly engineered laser-proof vault long before they finally plug their machine into the wall.
that's a great way to think about it. The urgency is mounting, even though the probability of a catastrophic hack today remains effectively zero. I mean, the most sophisticated quantum processors currently operate with fewer than 1,000 qubits, which is orders of magnitude too fragile and error-prone to threaten Bitcoin's encryption.
So we have some time.
We do. However, government agencies globally, including the US and the EU, are actively mandating that critical infrastructure migrate to post-quantum cryptography, or PQC, by the year 2035.
In the grand scheme of global financial infrastructure, a decade is the blink of an eye.
It really is. But the encouraging reality buried in the research is that the crypto industry is already engineering the laser-proof vault.
They're ahead of it.
Exactly. Developers are sketching out comprehensive roadmaps for network soft forks, essentially backward compatible software upgrades, to seamlessly transition the entire ecosystem toward quantum-resistant signatures. It proves the foundational developers aren't obsessing over this month's ETF outflows. They are actively architecting the network to survive the next century of technological warfare.
Bringing all these threads together for you, the contrast between the surface noise and the deep water is staggering.
Yes.
Watching Bitcoin test the $60,000 support line induces sheer panic. A $1.8 billion liquidation event is a brutal reality check for leveraged traders, and ETF outflows look terrifying on a daily chart.
Absolutely.
But the moment you look past the immediate price action, the institutional plumbing, from the explosion of $1.2 trillion in stablecoin infrastructure to the tokenization of private credit, is deeper, more robust, and more sophisticated than it has ever been in the history of the asset class.
The massive rotation of capital into artificial intelligence isn't a death knell for crypto. The AI industry is inevitably going to utilize decentralized blockchain infrastructure as its native settlement layer.
They need the plumbing.
They do. The volatility terrifying the market today is simply the unavoidable friction of a nascent, borderless technology violently integrating with the legacy global financial system.
Which leaves us with a truly fascinating final thought to mull over. If protocols like 5402 succeed in making it frictionless for autonomous AI bots to transact seamlessly, we are rapidly approaching a horizon where the vast majority of daily financial transactions are not initiated by human beings at all.
It's wild to think about.
If AI agents eventually become the primary holders, users, and traders of stablecoins and digital assets, what actually happens to the market itself? Does the crypto market finally stop reflecting human fear, human greed, and human panic over a tiny 32 Bitcoin sale?
And instead, does it begin to reflect pure, cold, unfeeling machine logic?
Exactly. A shift like that wouldn't just change the price of the assets.
It would fundamentally redefine what a financial market even is.
It really would. So the next time you see the surface of the market churning and the waves look like they're going to capsize the entire ship, just remember to look past the panic on deck. Look the current shifting 1,000 feet below.
Always look at the data.
Thank you for joining us on this deep dive. Make sure you subscribe to the show so you don't miss our next analysis. We'll catch you on the next one.